Yeah, hello, ladies and gentlemen. Again, this is part two of international taxation, the introductory lecture from of four people studying international relations. So, an introduction for the non-tax experts. And this is the second edition because I got the information there's something in the first video which I recorded on that topic was technically broken so that the video just yeah, finished after 2 minutes, and I don't know what's happened there on YouTube or wherever it happened. So let's try to do the whole thing again. Well, we should perhaps talk a bit about basic principles of tax legislation here. So the connections between general principles of international law and tax legislation. Officially, there is the principle of tax sovereignty. So that means sovereignty means nothing else than there is no higher authority than the state itself. It has to obey to no other higher authority, so it can decide whatever it wants to and to write its laws as it likes. This is the prevailing theory in public law, but historically it's rather an innovation. It goes back only some 350 years. It became generally accepted, or the prevailing theory only, as far as I know, since the Peace of Westphalia from 1648, which finished the 30 Years' War in Germany. So the basic outcome of that principle is that a state can make any tax law which it wants to make. So that means if you apply that to taxation, you can write every tax law which you like to. You are not bound by higher principles to which all states must obey. So you could levy a tax on dogs, but ignore cats when it comes to taxation, and also refuse to tax horses. You are the state, you don't need to give reasons for that. You can have the strange idea of taxing all the people having a beard. For example, that was one of the innovative idea of one of Russia's greatest Tsars, Peter I. He tried to modernize his country in a more Western-like style, and so to give people a strong incentive to shave themselves and renounce on their old-fashioned traditional beards, and especially to force them out of that traditional mindset. So his nice idea was tax people having a beard. So there, if you walk down the street, you either had to show when a control came, you either had to prove that you paid these year's beard tax, or you were shaved on the spot, perhaps. So nice ideas. A state may also tax houses according to the number of the windows. This was a very intelligent idea some centuries ago, when people didn't want to enter your house, but wanted to gain an impression of how rich you could possibly be just by counting the number of the windows of the house from outside. Then you got an impression how big the house was, and in a time when glass panes in a window were very, very expensive, that was also a kind of even more directive indicator for your personal wealth. You might still find some old houses somewhere in regions of Germany or the rest of the world which are bricked up, was a direct consequence of the tax on windows, ladies and gentlemen. There was no other reason for breaking up windows and closing the wall again. You might invent a tax on people's holiday. For example, who visits your island has to pay, for holiday purposes, has to pay a tax because of that. That, for example, was a German invention. You still possibly find that tax if you go on holiday to Sylt or another northern island of Germany, at least during my youth, that was the case. I've never been to Sylt to clarify that, but to another island, and we always had to pay this Kurtaxe. Mallorca tried to copy that model, but then there was an outrage in the German, is it the newspaper, the German Bildzeitung, and you can invent the most strange kind of taxes. Very famous was the Roman Emperor Vespasian introduced a tax on the usage of public toilets, and when even his son Titus protested out of opposition, the emperor coined the famous proverb, "Look, son, the money doesn't stink." And that brought us the proverb, "Money doesn't stink." Well, many, many more. And well, there are a few restrictions in theory based on the idea that state sovereignty in modern times could not be absolutely without limits, but there is nothing like a human rights convention on the way how taxation can take place. There was some intervention from the United Nations or from other nations when basic human rights are violated. For example, if a genocide is going on, then the idea is state sovereignty is restricted and in these areas. But there are no minimum standards for taxation comparable to what's going on in that field. So indeed, a state can do whatever it wants to in that area. It might be that there are some international agreements which limit the discretion of a state with regard to the design of taxes, but there are very, very few, and they are usually obligations which a state takes on deliberately and voluntarily, so they could also step down from these obligations again by just terminating the underlying treaty relations or even violating these treaties. Nobody could do something against that. So you don't even need to dream of a coalition of 100 nations invading a country because that country violated a humanity-wide standard of how taxation should be. That is never going to happen. So their states are really, really very, very free. So the few restrictions which one can imagine are in the WTO treaties, which say they forbid subventions, subsidies, state aid payments to certain enterprises to distort competition, and that also extends directly or indirectly to tax subsidies to enterprises. That can even be ruled upon by WTO dispute settlement bodies, but it's rather a kind of softer law. EU law also forbids subsidies and state aid to enterprises, but at least without the permission of the EU Commission. Here the legal supervision is a bit harder than on the world scale. There might be international agreements on the exchange of information which have to be followed if one does not want to get cut off from the international financial markets. For example, the Americans imposed a system some few years ago only that every financial account which an American sets up at a bank or other financial institution worldwide has to be reported to the American fiscal authorities by that foreign bank. If not, if a bank does not declare its readiness to cooperate with the American fiscal authorities, then the Americans will cut off that financial institution from the worldwide fiscal system by a very clever trick, because all the banks which cooperate have to sign an obligation that if a bank transfer has to be made to a non-cooperative financial institution, they have to split off the payment 30% and hand that money over to the American fiscal authorities. And that effectively ruins every non-cooperative bank. Then they afterwards offered to the states, foreign states, to replace that system by a bilateral exchange of information, mandatory, which discloses all financial accounts in both states on a bilateral basis. And so a real network of comprehensive exchange of information in that field has been established very quickly on a worldwide basis. More and more such developments are going on. For example, the OECD, the Organization for Economic Cooperation and Development, has undertaken coordinated measures against tax havens in countries in which people from the rich nations hide their private money. And since that point of time, the industrialized states or member states of the OECD very often say, okay, if we identify a country as non-cooperative when it comes to exchange of information, all of us are going to impose trade sanctions and tax sanctions on contacts with these countries. And that forces these countries usually to give in the medium or long run, and to take part in the cooperation of fiscal authorities. So in theory, they are all still sovereign, but in practice, more and more states are forced to cooperate with others and to coordinate their tax system. There is even still ongoing on the OECD level an initiative to end or restrict base erosion and profit shifting. So that is what multinational enterprises have begun some 30 years ago to do. It's a strategy how, mostly on paper, by contracts within a multinational group, they shift big parts of their profits to tax havens and low tax countries, which in reality are not really involved in generating that profit. And also there, much is going on to coordinate the behavior of the other states against the functioning of these models. Especially a new development is that in the future the states have, or at least between 70 or 90 states have agreed in a multinational treaty that in the future they will absolutely try to prevent models where an expense paid from the one state and leaving that state as a business expense, so untaxed, that in that case that money can arrive in the other state without being identified as a business revenue. So they want to oblige themselves to avoid a contradictory evaluation or assessment of payments in a way that in the end perfectly legally a taxpayer can obtain money without ever paying tax for it. That was a very popular tax saving model in global economy, to make a payment which can leave the one state legally untaxed because they regard it as an expense, whereas in the state where it ended up, it was not seen as a revenue, but as money which you already owned before, or the like, so that you didn't need to tax it there. If that sounds rather complicated, yes, it is. So don't be worried. The basic message here, which I have for you, is in theory, there is still absolute tax sovereignty of states. In practice, The forces of globalization seem to force states more and more to cooperate on a seemingly voluntary basis in the design of their tax laws. So there is no longer an absolute range of freedom when you design your tax legislation as a state. There will be certain habits or traditions, or there will even be certain needs to cooperate with other states and even needs to comply with certain expectations concerning the content of your tax legislation, which other states might bring forward to you, and with some, let's say, diplomatic pressure or even a trade war-like force will try to push through so that you comply with the general unwritten or written standards of legislation in the tax area. And that, ladies and gentlemen, is naturally something which should be of high interest to all of us, that beyond the stage or behind the stage things are going on, developments which theory does not fully cover at the moment. Well, there are nevertheless also some restrictions on sovereignty of states, even in theory. The most important restriction which we know on state theory is no state may ever extend its legislation to situations or cases which have no connection at all with that state. So Germany would never be allowed to regulate the behavior of a Chinese citizen in the middle of China, because any legitimate motive does not exist which could justify our doing so. Now, if you look to taxation, that means what you can do is you can apply your legislation if a person has a connection to your state. Indeed, that is what we do in income taxation. If somebody lives in Germany, then we can apply our legislation to everything which that person does all over the world. And indeed, tax legislation usually does exactly that. If a person lives in Germany, then we tax the worldwide income of that person, because we have the connection to our state there, and so we can tax everything. And Germany is not the only state who does it that way. 90% of all states and territories worldwide which levy an income tax follow exactly the same principle. They tax the worldwide income of their taxpayers. The second aspect which a state can regulate is if an event takes place or has a connection to the territory of that state. So if something happens in Germany, or if something affects the territory of Germany by its economic effects or so, we can regulate that. And indeed, so you find also, if foreigners, people not living in Germany, earn income from Germany, Germany raises a tax claim on that income. So you can see the two basic, let's say, borderlines or front restrictions on international legislation are directly reflected by tax legislation, because when a person has a connection to your state, you can regulate everything which the person does worldwide, and indeed that's the maximum you can do. And indeed, taxation directly comes and taxes the maximum of what that principle allows. Person is here, we take taxes on everything the person does worldwide. On the other hand, if the person lives abroad, then we are not allowed under international principles of legislation to rule or regulate on that what a foreigner does in a foreign country, but we can still regulate what they are doing here. So we tax the foreigners on their inland income. This is, by the way, called in Germany a limited tax liability. The worldwide taxation, on the other hand, is called the unlimited tax liability. and you already know the background. It has nothing to do with the tax rates. Limited tax liability just reflects the fact that in these cases, the tax claim is limited to what is earned in the inland. Whereas in case of a person living here, the tax claim has no limit whatever to the inland or so. We just tax everything that person has. And that may be sufficient to explain the two terms. A warning, please, might be added when you ever speak as an American citizen or so. Be highly cautious, or with an English speaking, or in general a foreign citizen. Be highly, highly cautious in using the term unlimited tax liability, or even speaking of unlimited taxation or so, because naturally the association of somebody who does not know the tax rules will be unlimited taxation, that the tax is unlimited high, so 100, 200 or 500%. So an American probably, if that person carries a gun at that moment, will probably break down under shock or shows a traumatic effect and begins to fire around and just regard your country as, yeah, as some country filled up by terrorists and bastards, and probably they think you are all communists. So how you could try to explain them is that you say we tax these people on the basis of their worldwide income, by the way, as you Americans do it in the same way. That might greatly simplify the task of interpreting between the two languages. Sometimes with a literal translation, one needs to be cautious. Now, in international tax cases, you have automatically an interesting effect, because an international case means by definition that you have a person in the one state and the income coming from the other state. So you will have in the home state of that person a worldwide taxation, so that covers also the income from abroad, and you will have in that country abroad a limited tax liability. So both states will raise a tax claim, so the same money will probably be taxed twice. At least that is a highly probable risk. And that risk of double taxation, that is one of the main topics of our lecture, because it very, very well illustrates what can happen in international relations when the legal orders, the legal systems of two states conflict, or when they both apply to a cross-border situation. Usually the basics of the legal systems of countries were set up 150 or 200 years ago. So when international contact was something strange, that was nothing which people took into account when they designed their laws, or when somebody had income from abroad, then people said probably from an occupied country, a colony or something else, that also other states which function could exist, did never enter the imagination of people who designed tax laws and other laws at that time. And now we very often still have legislation which is not coordinated, or which later became coordinated. So you have completely conflicting legal systems, where later the states tried to avoid the worst and tried to regulate coordinate these legal systems in a way that the damage from conflicts was minimized. And the interesting thing is, very often you don't see in real life so clearly the potential conflicts But in taxation, you can illustrate the basic possibilities of conflicts very, very easily, and you can make them very, very understandable, because taxation is an everyday thing. You can, well, it affects business transactions, so you can speak of concrete figures, and you can mathematically show which dramas can happen. When you look to other legal fields, for example, family law or so, it's usually more rare that you can point out the dramatic effects of contradictory legislation. The cases where you really find that in real life are more rare, and people always have the idea, well, it doesn't really affect myself. But in the conflict of tax legislations, everybody of us can be involved. And if somebody, for example, studies international relations, that person will sooner or later be involved in cross-border activities. And then if it's connected with money, then either your employer or you will also get involved in such conflicts. And so it might be a good idea to think a bit about the conflicts which might arise. One, let's remember that, could be double taxation. By the way, the headline of this subchapter here speaks of basic principles of tax legislation. And now you must know something. When tax literature speaks of principles, there are principles and principles. People have principles which they never violate. Then you would say a highly moral person, a person of principles, never does something wrong or so. And well, it's not meant as a principle in this way. In text literature, the word principle is always to be understood as a basic idea by which the law or the legislating bodies let themselves be guided when they write the rules. But they always will deviate from the basic principle if they think it's appropriate. So when something complicated arises, when a special situation arises, then they deviate from the basic principle and design the best solution for that individual situation. So a principle is not a binding rule for every possible situation, but it's rather the general guideline which the legislator follows. But there might be deviations when something special requires a special solution. So never have that idea. If you hear about the principle of worldwide taxation, then don't think that there are no exceptions. There will be. If you hear about the principle of taxation according to the ability to pay, there will be exceptions if the legislator thinks it's appropriate to make an exception, and all that, or the principle that people are taxed in their country of residence, and so on. So take the word principle with a grain of salt. Okay, now that having been said, there is naturally one thing which we still have to add. I told you in the beginning of this small part lecture here that a state in principle is still free to design every tax it wants to. You have certain factual requirements that you should not violate the interest of other states, because then they get a bit angry and perhaps you face a trade war. But in principle, you still have a wide range of possibilities. And now money is a rare thing. And what will somebody do who is a fiscal minister? He or she will just look for money wherever it is possible. And so In history, more and more taxes were invented by Parliament. Parliament can write any law it wants to, and when it comes to money, ladies and gentlemen, surprise, it will do. So we have a wide range of taxes, and so we classify them from time to time. We have the need to classify them in order not to completely lose the overview about all the taxes which exist. And one of the most popular classification systems is that we classify taxes according to the to the object what is taxed, or the object what is taxed. We distinguish their taxes on income, taxes on wealth, and tax on consume. Income is defined as the increase in your property, so the amount by which you get richer. Examples for taxes on income are the income tax, the corporation tax, also in Germany, additionally, a trade tax for businesses. Taxes on wealth are taxes on the property which you have on a given date. For example, in former times, Germany had a wealth tax where on the 31st of December, everybody had to pay, don't remember it exactly, 0.5% or 1% of the net property, so assets minus debts, which you had on that given date. You had to declare that, had to be calculated, and then you got a tax assessment on your property and had to pay the due amount within a certain period of time. Also, a tax on wealth is the inheritance tax. So if somebody dies, the property which is then inherited by the next generation or by friends or by whomever will be subjected to a tax. In that case, the rate is usually a bit higher, might range at 30% or even go up to 50%. That depends on the country and on the personal situation. There are sometimes taxes on certain kinds of property. For example, very, very frequent in many states is a tax on real estate property, so houses, buildings, piece of land, and so on. And the third category which you find is taxes on consumption or taxes on consume. That is the tax on the money which you spend. Examples is first the valuated tax, which is a tax on all the money which private consumers spend. Then there is a multitude of taxes on special goods. Additionally, for example, a tax on tobacco, a tax on beer, a tax on champagne, but also a tax on the sale of real estate transfer tax. Okay, that is not strictly consumption because you don't use up the good in question, but at least it resembles that. And what I especially find nice and impressive here is that if you look to that system of taxes, you see that your fiscal authority never lets you alone. The money is taxed when you get it, taxes on income. The money is taxed while you have it, taxes on property. And the money is still taxed again when you spend it. It's quite impressive. So they left no idea and no moment out. Now sometimes you will have a feeling which says, isn't that rather too much? But imagine somebody just has wealth and never works for it. If you only had an income tax, that person would not properly have to pay taxes for the common benefit or for the common budget. If somebody never consumes something, also that person would not be plundered by the state. You can imagine for each of these three indicators of ability to pay, that if you leave one completely out, so if you abolish the taxation of one of these three pillars completely, then certain extreme situations might be imaginable where one of the citizens doesn't contribute to public budget but is extremely wealthy, or so that one would regard the result as rather unfair. And a rather practical aspect comes on top. If you would abolish Pillar 3 and 2 completely and only tax income, you probably would need in a developed country tax rates of 80% or 90% of income, and that makes no sense. By the way, the ideas behind these three kinds of taxes are plain and simple. If you tax consume, the idea is if somebody can waste money for champagne, a new luxury car, and other expensive acquisitions, that person evidently has too much of money, and so that person evidently could also contribute a bit to the in favor of the poor, so in favor of the state. On the other hand, if a person gets new money and gets richer, that person's situation improves greatly, and so it would be nice if that person could also share the incoming money with the state. If you get richer, for example, if you get 10 million, it would be really unfair if you kept that for yourself instead of sharing with the poor, so with the fiscal ministry. And naturally, if somebody just has the money and sits on it and never spends it, like Scrooge McDuck, wouldn't it be rather unfair if Scrooge McDuck piles up all the money and the public is starving from hunger? So also that can be reasonably explained that a certain part of wealth should also be passed on to the community. Well, so you have this basic system which shows you that many taxes exist and allows you a classification, and you should know the most frequent examples and where they have to be placed, because that's rather a very common knowledge. And keep in mind, it's a direct result from the sovereignty of states. They can create every kind of tax which they want because they can freely design their laws. And when a fiscal ministry can do what it wants to with the help of parliament, then no surprise, it will also do that. And if a neighboring state has a good idea to find a new idea for a tax, then the new idea will probably spread and be copied by other states, and that is the main explanation for why you find these three categories of taxes in nearly all states worldwide. The second pillar, the wealth tax, is a bit dying out because an annual wealth tax requires much of bureaucracy. You have to measure your property once in a year with the market values, and you can only levy a very small rate on that. Otherwise, the people would never save money again but waste it. And so very often that happens that here you have no regular wealth tax, but on the other hand, you will have things like inheritance taxes in all probability. Good. That shall be enough for this time. See you again for the next part of this small introduction. And now I hope that this time the video is not going to break up for technical reasons, so that you can have seen it in full. If you can hear my words at this point, then it probably worked. Okay. Thanks for watching. Thanks for your attention. Hope to see you back soon. And till you come back, have a good time.